Good afternoon, everybody, and welcome to another episode of the Emerging Market Entrepreneur, a show where we dive into the entrepreneur's toolkit and the options that are available to us when it comes to refining your business during this COVID-19 pandemic. I have with me my co-host, Alexander Neeps, the co-founder and CEO of Printulu, and Safiso Skenjana, the chief economist at IQ Business South Africa. Thank you, gentlemen, for your time.
Thanks, Ed. Great to be here.
Thank you,
Great.
Sid.
So
Quite excited about this episode.
Yeah, me too. Just for people that have not caught up with us before, we have covered things like cutting variable costs. We've looked at how do you refine your fixed costs. And today we are going to talk about injecting capital and other forms of liquidity that you can put into your business, either through raising equity or debt or grant finance. So let's get the ball rolling and jump right in. What are your views on raising equity at a time like this? Is it wise? Is it something that you need to be wary of, given how businesses might be performing? Alex?
Yeah, thank you, Sid. I think generally, raising debt and equity, speaking just from these two, you always want to raise these two from a position of strength. Now, unfortunately, everyone is in a position of weakness. So if you can avoid it, don't do it for sure, because everyone is scared in terms of from the investors, whether that's debt capital or equity capital. Everyone is scared right now that they're going to lose more, and what is happening right now is that if you're an investor, you've got a portfolio of 10 companies, 8 are struggling right now. Now you need to give more money to support these companies in order to make the same return. You're expecting that 6 out of them will go bust, and then 2 you need to make a better return on. That means your valuations are probably going to drop, and from an incentive point of view, that's the struggle that you're going to face right now with raising capital. Everything is going to be more expensive, and avoid it if you can. But we're talking about right now is obviously COVID-19. You probably need it, assuming that you've cut all the costs that you have to the bone. So Alex, do you have anything else to add there, maybe?
The point that you make is certainly a valid one, that, I think on the first instance, certainly avoid it where you can. But I think also, we find ourselves in a space where a lot of models have changed, and the market structure has changed. And so that may necessarily necessitate actually a lot of consolidation in certain sub-markets and sub-industries. And so I think also the call is that maybe businesses shouldn't be too averse to exploring opportunities for partnering. I think we are moving into a world of shared value as well. And so, the old M&A models are certainly not relevant in today's context, and the funding structures that follow them also are quite different. And so I think there's also an opportunity there, is that in the event that there is an opportunity for a business to partner with another business to be able to respond to the current market structure shift, as well as the economic pandemic that's followed the health pandemic, I think there's certainly also value in businesses exploring that avenue as well.
100%.
Alex, I want to quickly come back to your point on an investor's portfolio. If you have 10 investments and you see that 8 of them or 6 of them are likely to go bust, don't you think that if the investor doesn't shore up the balance sheets of some of these investments, the likelihood of them going bust is higher? So wouldn't you then want to look at companies that have had sound business models pre the pandemic, and then kind of extrapolate that going forward and say, well, these are the horses we need to back? So and doubling down on the ones that show prominence.
Yeah, so I think you're right there. Based on my background and a lot of my friends that I studied with, being in the finance industry, I had a lot of chats with them around this topic. And the problem is, yes, money is available, but it's also limited. It's not like, it's growing from the trees. So what they actually said to me is they have to do triage now with their portfolio companies, so that there is not enough money because there's such a liquidity gap now to fund everyone. So you have to pick and choose right now. But it is difficult also for the investors because they are also scared. They don't know how long is it going to take, how much money is needed. And if you really then want to make sure that, you know, the two horses you're betting on, that probably means 6 will go bust. And I think that's the challenge. And probably investors take different stands here, but I'm just talking about the trade-offs that the investors have to face as well. Because yes, what does it help if you give 8 companies that you have in your portfolio a little bit of money, and then everyone doesn't survive, or won't survive? Or the alternative is you give, you know, selected ones that are most robust more money in order to sustain longer. Different strategies, different portfolios, different choices, but it's certainly also not easy for them.
The banks, some of the banks, at least in the South African context, have been doing, for example, is they've actually been capacity building the value chains of the businesses in which they're invested in, right? And so it's an understanding that if I don't take care of their value chains, and then my value chain doesn't get taken care of. And I think that's an interesting model of portfolio management now that investor companies should also be, I think, exploring and saying, maybe the structural constraint is not in this particular business itself, but is in the businesses that it interacts with in its own value chain. And so what does it mean for you to ensure that you take care of that portion of the value chain so that this business stays afloat? And I think those are some of the things that could probably inform also the choice and the strategy that the business makes in terms of whether or not to continue injecting more equity or more funding into that business, or to jettison that business completely. And I think there's also an interesting thing now around, do you currently look at the business models that you invested in and say, actually, maybe in this format, this business won't be sustainable. So let's close it down and restart something. And so we're seeing it, for example, and yes, it's an absolute terrible example, but in the way they're thinking about SAA in South Africa, but they also did it with African Bank when the bank went, it had a run pretty much. There was a bank run, and it had a terrible, book, and they said, we're going to separate this business into a bad bank and the good bank, and we're going to show up the good bank. And over time, that bank has come back, and it's actually really, truly operational. And so I think there is certainly an opportunity also for businesses to look, and particularly investor businesses to look and say, is there an opportunity for us to either strip sell this business and reinvest into a growth component in the old business?
Mm-hmm.
Sure. So let's just look at it from the entrepreneur's point of view, and what both of you are saying. From the investor's point of view, Sophie, so you talked about making sure that the ecosystem that a company is in also survives, because you can't really exist in isolation. But then you're also saying that certain businesses should shut down because they simply aren't viable. How do you go and convince an entrepreneur? Because usually the shareholders and investors aren't the ones running the business. It's somebody else who has a dream and a vision, and they probably think that they can come out of this smelling like roses. So, what do we say to people like Alex if you tell him that his business is not viable?
I think it's certainly the starting point is never to move towards, I guess, cutting your losses, but in trying to say, how can we pivot the strategy into a sustainable trajectory? And so it certainly is, I think, a conversation that is an ongoing conversation that happens with all stakeholders, and say, you review the strategies and you stress test those strategies, and you see whether or not there's true economic viability based on those strategies. And maybe then as an investor company, you also bring a strategic view around, which part of the market this business can, reoperate if you close and shut down. But if it's truly a space where you just can't, there's no opportunity for pivoting, so no opportunity for closing and restarting in essence, and then that's certainly always going to be a tough decision, right? It's then the investor really just making a call on its investment and saying, we are here now, we don't see any value in our investments. How do we, transition out of this kind of business model in the best way that hurts the least amount of people and ensures that you are able to at least still have some reputation protection in the context of the industry that you're operating in.
So what I've seen in this
Sorry.
context, what I've seen is that showing a trajectory and showing you have a viable model in the future post-COVID is 100% important. But given all the uncertainty around the assumptions that you have to take, even that is a very, very difficult discussion to have at this moment in time where you're going to be put in place. They're basically changing weekly, So with that, your whole business plan changes, your cash flow planning changes. And therefore, what I've seen is show operational excellence. I think that's the only thing you can really show, and then start a conversation in terms of, okay, viability of future businesses. But I think right now it's showing you can turn this business into, you have to cut costs basically and effectively. And you need to show that. You need to show that you can run this business at a 50% lower revenue for the next couple of months, maybe even 6, 9, 12 months. And after that, it's a discussion around, okay, now you are kind of self-sustaining. What other avenues do we have to invest in? And that's a different discussion than you can have. And then again, you're coming out of a position of, not stress to raise capital for strategic projects. I think this goes hand in hand, in my opinion. This would be my strategy. But we are going really into equity funding. What are the kind of trade-offs as an entrepreneur, Sid? Maybe you can go into that, whether you want to raise debt or equity. What are the kind of the criteria that you would look at? You know me, Sid. I'm always like, so what? Now, what do I have to do as an entrepreneur? I want to act now.
So to be honest, I think in this environment, you're probably better off raising debt than you are equity, because you don't want to be negotiating your cap table from a position of weakness. And the interest rate environment is declining, so it's probably a good time to do that. The problem is the repayment terms and the assumptions that go into your cash flow forecasting in the future. If you're able to negotiate debt funding where your repayments are sort of towards the end and you have a payment holiday, then good on you. I would take that. I would also, I took a class on entrepreneurship when I was in university, and my professor actually said, when you're starting a new business venture, don't give away equity. And if you have to exhaust all lines of credit cards, personal loans, that's what you should do. I don't know if that's good advice, but if that's something that you can do today and access all the pools of liquidity that you have available to you in the form of short-term loans, in the form of credit card debt, then go that way, that route first. It also depends on what it is that you plan on using that money for. If you're raising debt to pay salaries, for example, then that's a bit of a vicious circle that you're never going to get out of. But if you're raising that debt to help fulfill an order, and there is money attached to it, then that it makes that conversation a bit easier. You'd rather go and align those cash flows, so it's cash out for one thing, but then there's cash coming in for another.
So you're touching upon a great point. I think debt, that's what you learn at school, is debt is always cheaper than equity, basically. But you're mentioning a great point of what are the difficulties in planning your cash flow if you have to amortize and pay your interest, basically.
Sure.
So basically, would you say it's around, if you're really, you need money next month. So if you say, would you raise equity or debt? You can't pay salaries next month. You've cut all the costs. You're standing in front of a wall. You have one shot: equity or debt.
No, it still would be debt. I think particularly in this context or in this economic climate, there certainly is a lot more opportunity that is coming up of soft loans and concessional funding. And so that's what Sid was talking about, where you might get some debt holidays or payment holidays. And I guess, again, even if it's to pay salaries between taking equity and debt now, I'd probably try and figure out a way how to, contextualize that debt raising into some form of working capital loan. and that would be my first choice, certainly, before I take a view on going for equity.
Okay.
Well, Alex, there's another form of debt that you could raise, and that's in the form of your creditors, payment holidays from people that you owe money to, or payment plans. I know we touched upon this last week as well. So I think that would be the first protocol in the event that the money that you need is to actually pay vendors as opposed to pay salaries. So just wanted to bring up that point as well.
100%. Obviously, extending the credit lines with your current suppliers is first prize. Second, then is going to a bank. But how would you go about this? If I'm an entrepreneur and I don't know how to raise debt, how would you go about this?
It depends the kind of business line that you're in, right? And so there's a view, for example, of refinancing some of your assets. That can be one of the options that you look at, and in essence, that enables you to rebond assets that would have ordinarily been paid up. Outside of that, I think it's truly, whether or not you're having a conversation with your funding structure, whether it's banks or investors, around, for example, invoice payments or invoice guarantees type of structures. And so sometimes there's a blockage that you're not being paid, and therefore you can't operate, and so you can guarantee your invoices, and so there's an invoice offtake type of a structure that they can do, and you often take a haircut there, but at least it'll inject some liquidity into your financial structure. As I said, there's also the opportunity of either looking at a working capital loan or a soft or concessional loan, depending on the institution itself that's providing that. Over and above that, then of course, I know we're still going to get to grant funding, but then you may also explore other opportunities for grant funding that hopefully could come to your rescue.
I think there was a great news actually last week already. I think they launched it end of last week. It's all major South African banks and the Reserve Bank. They all came and sat at a table, and they made kind of a rescue loan package or something like this together. And I think all those major banks, they now offer loans at prime rate, and no other charges involved. And I think a 6 months payment holiday, and you have to pay it back otherwise over 5 years. So this is quite a good deal, and I encourage all entrepreneurs to look at it. There's obviously no data yet around who gets accepted, who doesn't get accepted. I know there are some things that you need to take into consideration in terms of liability, in terms of what you can use the money for. So you can't use it for retrenchment packages. You can't use it for dividends. So there are a couple of strings attached, but I think generally for everyone out there, these are good deals. That's certainly better than anything out there that I've heard before.
What's quite interesting about that also, which really shows that the banks are putting their skin in the game, is that they've guaranteed losses up to 9 billion first. So it's a credit guarantee scheme that's backed by National Treasury, but they've guaranteed losses up to 9 billion first before then I guess there's a call on the fiscus itself for them to show up those loans. And I think, it talks to, again, the confidence that they have in their credit modeling, capabilities to be able to ensure that they're able to minimize, those credit defaults as far as possible. So, which is quite interesting and quite good. I think it's a vote of confidence, I think, from the banking system into the entrepreneurs in the South African ecosystem.
Well, that really depends on how easily they give their loans, right? Now, if no one gets their loans, then the whole endeavor is a little bit useless.
Well, this is why you're here, Alex, and hopefully then you can submit, your contribution around what kind of loan structures could be put in place, what kind of facilities would be useful for small business owners, medium business owners. And I think this is also the important thing, that oftentimes small businesses, wait to be receivers of whatever changes that are happening. And often there's valuable insights that you can share back to policymakers and the banks around the kind of financing structures that would enable a more inclusive and a more sustainable, I think, funding relief into small businesses in the country.
100%. Okay, we touched up on equity financing. We all not fans right now, are we? Not
right now. If you're trying to raise equity, or worse, if you're trying to IPO your business in this environment, you're just fresh out of luck.
What about safe note and convertible loans? Is that something you would look at?
Well, see, if I was starting a new venture or I had a young venture, then potentially I would look at a safe note. And I think that's a good kind of a hybrid model where you're basically promising equity. So you're off the hook for the repayments in the future. But as it currently stands, you receive money in the form of debt. I don't have a lot of personal experience with safe notes, but I would consider doing some more homework on it.
Okay. So I just for all entrepreneurs out there, I mean, a safe note agreement is basically an agreement for future equity, and you're guaranteeing it based on a certain liquidity event in the future, or whatever event actually you're determining. So this could be a further fundraising, or it could be just time. It can be quite anything. What I do recommend for every entrepreneur out there, make sure you are hard on negotiating the discount and kind of the floor in order to be able, not to minimize your risk. But I mean, it's a very specific topic right now to go into. So if you before raising equity, try to do some homework on safe notes and convertible loans. Because they could be a better option right now in this environment, because you're postponing the value discussion to a future date, basically. And right now, you don't want to have a value discussion.
Yeah, I think it's an interesting point that gets raised about dilution. So, do you want to save your business? Do you want to survive, or do you want to have 100% of nothing, or would you rather have 50% of something? And that's another trade-off that entrepreneurs have to think about. But let's talk a little bit about practical steps that one would have to do to raise equity. So I'm not sure what levels of enterprise there our audiences is that. But if you're a young business, if you're an SMME or a micro SMME, you've likely raised money from savings, from friends and family, that sort of thing. So perhaps having that conversation with your wealthy benefactor or your angel investor wouldn't be a very difficult one because of the situation that you're in. But what do you do if you're a larger business and you need to raise, I don't know, private equity money? Is it a good time to do that?
Yeah, so I mean, it's as we said, I think valuations pre-crisis are probably looking now at about 70% discount on those pre-crisis levels. And so, whatever value is attributable to your business now, it certainly probably won't be a true reflection of the intrinsic value or embedded value, depending on whatever methodology you're using to value your business. And so an equity raising right now will certainly, I think, be to your disadvantage. But as I said, I think, and Sid, you touched on an important point around dilution and would you rather own a large portion of nothing or a smaller portion of something bigger? And I think it's the core to entrepreneurs, I think, and their belief in their business models. Is it an ego thing around ownership? Or is it truly believing that this is a business that can transform industry and truly add value? And so over time, I'll be able to, I guess, recoup, if I can use a very rough term around that, some of the equity losses or equity, that you've given away by virtue of the growth that you model into your business as well. And so I think it's certainly not a great idea, but there may be times where a hard pill may be swallowed by an entrepreneur right now, particularly given your own view of your business, and you think that it's got legs, and so over time you have a beneficial share of a larger pie.
If I would be an entrepreneur that wants to raise equity funding right now because I want to have a smaller portion of a humongous pie, as you guys are referring to, what I would do is I would engage, investors right now they are also looking for opportunities right now. They have cash, they are sitting on cash. So if you have a business, you believe in it, and you think you can raise funding, go out there and speak to as many people as possible. Get referrals, go to your startup grind events, and go to speak to your friends, and try to get the conversation going with a lot of VCs and angel investors out there. If any one of you needs a hand or help there, I'm sure all of us can refer any of our audience to some. So please feel free to reach out. But generally, that's the recommendation. You need to get it's networking. You need to get the conversation going.
Yeah, and we've currently now got a platform. It's called Cobra. It's a COVID business rescue, and it's actually grown quite interestingly, over the last few weeks. And it's an ecosystem. It's now grown truly into an ecosystem where, on the one side, we've got a lot of industry partners, and so we've got legal, we've got business rescue practitioners. We've got equity, private equity. We've got, corporate financiers, all in the ecosystem to help small businesses, actually no, small and large businesses who are under distress in the context of what's happening right now, to see actually how do we ensure that you are able to get back into a sustainable operating path. And I think it's quite an interesting space in general, because historically, I think it's about 10% of businesses that have gone to business rescue actually made it back out. And so what was quite interesting when I looked at, for example, Come, is how they've now gone into business rescue before their backs against the wall in order to restructure their capital structures as well as the operating model to ensure that they can operate more sustainably. And I think that's the core, I think, for businesses now, is that they must also not wait until the back's against the wall, because, as you said, Alex, you must negotiate from a position of power and a position of strength. And so as you can start to see that there are a number of your revenues are at risk through various platforms, and then go through the structures that can potentially link you up with the right financiers, the right investors, the right legal support, and right operational support to shore up your business and get to get back into a good operating path.
Fantastic. I think that's all we have time for today. Gentlemen, thank you as always for your time, and look forward to seeing you again next week.